There's something else that you need to know about money. As time passes, money will lose its value because of something we call inflation. In 1913, a gallon of milk cost around 36 cents. In 2013, the price rose to $3.53, nearly 10 times as much. Most countries aim for an inflation rate between 2 to 2.5% annually. This number is how much value the money you have stored up loses every year, meaning that saving all your money in a bank account actually becomes a problem over time. And that's when you're presented with this term, investing, the idea of using your money to make more money to beat this rate of inflation. You've probably heard about this stock market thing and how it's one of the easiest ways to invest your money. But what even is the stock market? How do you even begin investing in it? And is it truly as lucrative as other people want you to believe?
Markets open again after the worst week since the financial crisis.
Big funds, the hedge funds.
The Dow jumping 200 points at the open this morning.
It's just a good place to put your savings.
You suddenly put them together and you say, damn it, that's what's happening.
A market is simply a place in which things are bought and sold. If you live in a country like the United Kingdom, the United States, or India, your economy is very much fueled on a wide array of markets. For example, a fruit market deals with the buying and selling of fruits. A real estate market deals with the buying and selling of houses. And the stock market deals with the buying and selling of stocks. Which begs the question, what exactly are stocks? A stock or a share, both terms are used interchangeably to essentially mean the same thing, represents a part ownership in a company. If company X had a total of 10 shares, sometimes commonly referred to as the outstanding shares, and the founder of this company owns all 10 shares, they own 100% of the company. If the founder owns 5 shares, then they own only 50% of the company, and so on. Now, we often refer to those who own shares in a company as a shareholder, but this begs a new question. Why would a business owner or a founder decide to sell shares in their own company? Imagine for a moment that you owned your own company, a bakery. Things have been going well. You own the best baked goods in the area, and sometimes customers are queuing beyond the door, but you're aiming big. See, you truly believe that your bakery company and the goods that you produce are the next best thing in the industry. And so you want to expand your business. You want to open up more chains, hire more employees, run bigger marketing campaigns. But to do that, you're going to need to raise more capital or money for your company. Now, you could go to the bank and ask to borrow money, but that means paying interest on that loan. They might even deem you too risky and refuse to accept your offer. So another option to raise capital for your business is by issuing or selling shares in your company. You can either do this privately and sell those shares to some good friends who believe in your business, or you can do this publicly and have those shares sold to anyone that wants to buy. This would be done through a special event which is known as an IPO, an initial public offering, whereby your private company becomes a public company. And so, after another successful day at the bakery, you decide to do it. You decide to IPO.
Frenzy on Wall Street today for the initial public offering of Twitter.
Bulletin board pricing its IPO at $19 each.
Electric car makers surged to nearly 41%, the second best IPO gain of the year.
Well, tremendous interest in this IPO this morning.
Uber has priced its IPO at $45 per share.
Part of going public as a company is deciding on how many shares of your company you would like to actually issue, and the number of shares you issue to the public is commonly referred to as the float. Now, the initial value of each share in your company is determined by how well your company is doing financially, how similar businesses are doing, and how much demand there will be for your shares when they do go public, along with many other factors. Public companies will then have their shares listed on what is called a stock exchange. To explain this, let's use fruit markets as an analogy. In your city, there may be numerous amounts of fruit markets, but you will have the choice of only one of these fruit markets to set up your fruit stall. Now, instead of fruit markets, imagine they're called stock exchanges. They're the actual place at which the trading occurs. And instead of fruit stalls, there are a bunch of companies listed at these stock exchanges. It's up to you to pick the most appropriate exchange to list your company's shares. And each stock exchange will have their own specific requirements in order for companies to have their shares listed and traded there. Some of the biggest exchanges in America are the New York Stock Exchange, founded in 1817, the Nasdaq, founded in 1971, most notable for having some of the biggest tech companies listed there, such as Google, Apple, Amazon, and Intel. But stock exchanges exist around the world, not just America. Now let's introduce stockbrokers into the mix. A stockbroker purchases and sells stocks on behalf of an investor. They act as a middleman. In the past, brokers would go to what is called a trading floor at a stock exchange, shouting over one another, trying to fulfill their clients' requests. But thanks to the power of technology, this process has become more and more automated and is done using computer algorithms. This actually reduced the need for a physical location for a stock exchange. The Nasdaq, for example, has no trading floors at all. So, how does a trade actually happen? An investor will first go to a broker and make an order for a share, just like you'd make an order for Amazon. This order, however, will include a few extra details in order to help your broker. First, you must actually specify the company in which you'd like to buy or sell shares in. This is often represented through what is called a ticker symbol, which is just an abbreviated name to represent a company. Apple's ticker symbol is AAPL, Amazon is AMZN, Tesla is TSLA, to name a few. You can find out what a company's ticker symbol is through a quick Google search. Next is the side, which is, do you want to buy or sell shares? Then you have the type of order. You see, it helps to see the stock market as an auction market. There are thousands of buyers bidding for how much they want to buy a share for, and thousands of people selling, asking for a certain price. When a buyer and seller match, the trade commences. This happens millions of times a day, as the price of a share fluctuates based on the supply and demand for those shares. One order type is a market order, which essentially tells your broker to buy or sell that share at whatever price is available on the market. Another order type is a limit order, which, like at an auction, sets a reserve price for the shares you want to sell or a highest bid for the shares you want to buy, meaning you won't sell for anything less than your reserve price, and you won't buy for anything more expensive than your highest bid. Of course, the risk here being that if the stock never hits the price you're aiming for, then the order will never be filled. Now, there are other order types that exist, but a market order and a limit order are generally considered the big